This is a cracking episode where we are going to be discussing everything to do with trusts, APRA, the latest DTI changes, and how to protect yourself moving forward in 2026 and maximize your borrowing capacity so you can continue to invest. We've got Yousuf Ahmadzai from Flint Invest here with us today talking about it all. Let's go. Welcome.
Michael, thanks for having me, mate.
Thanks for joining us here in the
Zdravo.
hood. In the hood? Zdravo. Kako si? Mate, good to see you.
Thank you so much for having me.
The reason for our chat, we want to talk about what's been going on. There's been a lot of lending changes right now. So many people worried, inquiring, asking me questions, asking you questions. We want to address as much as we can in this episode so we can provide everyone with so much value in regards to what's going on and how to still navigate this market, right? Because property is a game of finance. The more access you have to finance, the more you can buy, right?
100%.
The more debt you have, the more wealth you can create, right? So ultimately, we need to protect that borrowing capacity and be able to scale moving into 2026. So a lot of things happening recently.
Absolutely. A lot of things have been happening and it's very exciting, I think, for 2026. The hot topic has been trust lending for the last 12 to 18 months. So I think we'll start there.
Yeah.
We've seen Macquarie Bank, CBA pull out of trust lending in different ways. So if we look at trust lending, and despite the recent popularity that it's gotten over the recent years, 10, 15 years ago, trust lending was primarily used by sophisticated investors who would put down 30 to 40% deposits. They would use it for tax efficiencies, estate planning, all these other different reasons, and the lending benefits would just be a byproduct of those. But what we've seen, I would say, after 2020 is the rise of social media. We've seen property investment specialists come into the limelight and really promoting strategies like rent vesting, borderless investing, which is fantastic because myself and many clients have built substantial wealth through those strategies. But with these strategies, you need a lined up lending strategy as well. And by extension of that, that's where trust lending has now really popped off over the last 12 to 18 months. Not so much by those sophisticated investors that we've always seen, but just by mum and dad investors as well. And we see it in the data. So investor levels are at 40% right now, exactly where it was in 2017. And that's when you had intervention from APRA. The same thing we're seeing right now.
Mate, it's very true, right? These strategies were all there, but the rise has happened a lot, so much more on social media lately. But I'll tell you what I love, and this is a little bit of a side note here, but I love that the trust and the system is set up for the rich. But I love the fact that the poor mum and dads just scraping through and those investors that come from nothing are hacking the system the way in which the elite are. And if you don't know whose side I'm on the side of the common man. I want us to all succeed. And we're just using those avenues that the elite and the wealthy have known for many years. Because we didn't learn all this starting out. So if you can't tell, I kind of love the idea of the trust and entity lending. But you're right, it's changed a lot. And Macquarie coming out, when was that? November?
Yep, about 3 weeks ago for the time of this recording.
Yeah,
yep.
and then CBA followed suit. Now, a couple of years back, I actually said, this is way too easy of a loophole. At some stage, they're going to close this, and I've got to find that content. And if we can find it, we can relay it and put it put a link in the comments. But
Nostramatus.
Yeah. No, well, it's when something's a little bit too good.
Yeah.
To be true, you got to be a bit cautious about it, and that's what it's been. And a lot of investors have scaled amazingly whilst protecting, amazingly large portfolios whilst protecting their borrowing capacity. And then Macquarie coming out. And then CBA shortly thereafter. Has APRA put the squeeze on Macquarie and CBA? Is that where this is coming from? Where do you think this is coming from?
Yeah, it's interesting, Michael. I think it was probably in February this year, we saw ANZ apply a 75 basis point loading for company loans. And that was the first time I actually sat down and thought, okay, well, a major lender who has very pro-investor friendly policies has actually taken a bit of a stance to say they don't want as much of this on their books. This wasn't really talked about that much at the time. A few months later, I noticed about 3 or 4 times there were other lenders who reported company and trust loans to the client's individual credit profile, to the credit records. When I saw that happen, I thought, okay, well, maybe there's a bit too much noise in the industry about this, where something now can actually cause a bit of intervention. Now, Macquarie Bank have always been the front runners in company and trust lending for the reasons that they give you the lowest rates, 5.79% interest only as of this current time, 24-hour approvals. So in a heated market, buying properties between 500 to 700, you need those finance clauses to beat other potential buyers. And if you have that speed, it's everything. They give you offset accounts, all the good stuff. So for them to pull out, it raised alarm bells for all investors, not so much because they can't go to another lender, but usually how other lenders respond when Macquarie makes an announcement. And we literally saw that play out with CBA in the next 3 weeks, where they said, we are not necessarily stopping it, but we're going to put the walls up for new-to-bank clients, where what they want is ideally you to have a loan facility for 6 months prior. Could be a personal loan, business loan.
So maybe take out a CBA credit card for 6 months and then get into CBA. Not that this is any advice for anyone at home, but if you do something like that, could you theoretically?
I have a friend that works in the branch, and that Saturday they were open in Wirringham Mall. He said that he's never gotten so many credit card applications, and this is what I love about investors, is they're always so solutions oriented,
and we find a way.
Within the hour, they're already doing what needs to happen to get them moving.
I love that.
It's super interesting. So, mate, that's the thing. Policies always change, and I think the hallmark of a good investor is the ability to pivot and to move. And I don't think it's really APRA initiated. We've seen other announcements from APRA being made, but I think that the lenders are starting to pull back their appetite because they probably don't want to absorb the level of risk. It only takes one rate hike, which is not out of the question anymore, for a lot of these clients who are self-sufficient to now be potentially under the water.
So what you're referring to for everyone at home, they're the self-sufficient trusts. So they might have a property in the trust. That property may or may not be covering. Not that I'm going to speculate too much because I don't know. This is a fictional character right now that we're talking about. This is, investor A, and investor A might just have that letter from an accountant stating that that trust is self-sufficient when it may or may not be self-sufficient. And they're worried. So you're thinking it's not APRA-led. You're thinking it's the bank going, maybe Macquarie and the board of directors, they're sitting there in lending going, okay, we've got way too much exposure to a bunch of different investors who are just, who have 8 or 10 or 12 or 15 properties. And maybe that's not the client that we're looking to achieve. We've got way too many on our books right now. And they're probably just assessing that risk. So you're thinking that's what happened as opposed to APRA calling Macquarie and saying, hey, guys, you have to stop this.
Potentially. Yeah, absolutely. I think if you look at Macquarie, they've got very robust, rigid metrics. They don't lend above 80% for interest only. Now, when you see an influx of company trust applications and they can see internally these clients have X income, they've got Y commitments. Yes, they've self-declared the self-sufficiency because that was what Macquarie did. But they probably have the ability and the oversight to say, maybe we've got a bit too much on our books now and our appetite has reduced. And they haven't said they've stopped altogether. They've said they've put a pause on. And I think they're just letting the dust settle before they announce what their actual stance is going to be for 2026.
Fingers crossed they're back. Look, it's the bank's job to lend money. They make money off us all. Without, handing money out at an interest rate, they don't make money.
Yeah.
Unless they're doing fees, but I don't they love their fees.
That's right. The other interesting one, Michael, is in 2021 when rates were still 2.5% and prices were much lower than what they are right now. You could have properties in, these regional areas that were actually positively geared or just neutral. But as rates have jacked up to, north of 6% and yields have started to compress as well, you're not necessarily achieving self-sufficiency. If we're purely looking at it from an income exceeding expenses point of view, that's also another reason I think that the banks have actually shifted now.
You're 100% right. The days of the positive cash flow and all that was your 2021. As soon as the 2022, then those interest rates started in 2022. And it started going 1, 2, 3, 4, 5, 6, what was it, 14 in a row or roughly thereabouts, here or there. That put an end to the positive cash flow in Australia. Everything's negative. It's just a matter of how much the negative is. That's the question.
100%.
But back in the day, 10 years ago, I went and bought, a heap of properties all in 1 year and I averaged 7.5% yield across the lot with my highest being 9.4.
Good old days.
Easy, good old days, right? And now it's harder. And the banks aren't stupid. They know that there's no positive cash flow. They're wondering, they're sitting there going, hang on, You've got the paper here from the accountant. How's this self-sufficient? So at some stage they catch on. Like they want to look the other way, but it's fairly obvious.
That's right. And then you ask yourself as well, how much validity is there in these letters being provided by certain professionals?
Yeah.
The pressure that you feel as a professional where you've managed a client's affairs from A to B for a long period of time and then you are being requested for a letter, it might be very difficult, to say no in certain instances for clients.
Yeah. Yeah, no disagreement there. So looking at that now, what can the investor at home right now do with these changes? So these changes have occurred now.
Yep.
What do we tell the investor out there watching our podcast now? How do they go about their 2026 investing?
Yep, 100%. So I think one thing we do as brokers or as a good broker being strategic is we speak to a client and we want to understand what is your desired end goal at the moment. And obviously goals change over time as we grow and mature. But let's say, for example, if I speak to someone today and they want passive income of 150K in the next 10 years, that might mean we need a gross asset base of $8 million by year 10, which means if we reverse engineer that goal to today, we might be looking at $4 million of acquisitions we need to make. Now, what is the gap between what we have right now and that initial asset base we need to accumulate? How do we now strategically sequence the right lenders so that we can achieve that asset base? And it needs to have an incorporation of not just one lender where you'll cap out at, let's say, 50% of what you could, but now exploring down the spectrum of lenders, mid-tiers, specialist lenders, and just keep moving down that spectrum so that you absorb as much borrowing as you can. That is the strategy. I think that's going to take much more of the limelight in the next year or so. I think clients will need to get more open-minded with taking on board new lenders into their portfolio. One that'll give you the money isn't going to be the one that's going to give you the lending today.
This might be paying an extra point, right? So tier 2, tier 3, is that what you're suggesting?
Yeah, so interestingly enough, you've got Resimac and First Mac, lenders that'll actually have sometimes lower interest rates at a 90% lend, but give you 40% more borrowing capacity.
Yeah.
Then you've got some more aggressive lenders like Liberty, Pepper, Latrobe, who will usually come at the expense of a 1%, 1.5% higher rate, but they'll give you 2x the borrowing, give or take, and that might mean buying another 2-3 assets, which if we grow and compound over your 10-year journey, that's going to get you to that long-term goal of 150K passive income in that scenario.
100%. And as an investor, I just look at it and go, well, that's the cost of doing business. So whatever that application fee is and whatever that interest rate is, that's the cost of doing business. So
100%.
So I think you touched there on sequencing. And for the investors at home, I think a lot of them will understand this, but for some that don't understand, could you just explain that? So let's say I'm coming to you and I'm just starting my journey. Yeah, I've got $200,000 and I want to scale that portfolio. And I'd love to see that $150,000 passive income because I'd love to, retire and live overseas by the time I'm whatever, right? 2033.
Yep.
Explain the sequencing and how they can best set everything up. Like how does that all work for someone that's new?
Absolutely. So the first conversation will be how much capital do you have? And what's your borrowing capacity? These are the two primary levers that we always need to pull and protect so that we can maximize what we can get out of the banks. So if it's a first-time investor, we'll usually begin with tier ones or major banks. There's not too much discrepancy for your first one. So if we go with a lender that usually gives you the lowest rate, let's say it might be NAB to begin with, we might put down a 12% deposit because we want to keep the rest of our capital preserved should we need it if the equity growth isn't there to buy property number 2. So we've now absorbed a certain amount of our borrowing with NAB. We've got a certain amount of borrowing left over. Now we would probably explore a different lender that's not a tier 1 or a major bank. It could be a lender, like I said before, maybe First Mac or Resimac that gives you a bit more of borrowing capacity to justify another investment grade purchase. And we keep following that process until we hit a ceiling of borrowing capacity.
So let's say we've got someone at home. This might be a little bit on the spot actually. But let's say someone's at home, they got 200K.
Yep.
They're earning 150.
Yep.
They're going to scale a portfolio. What sort of a portfolio could they set up in the next couple of years to get to their 150K passive income in 7 years or 5 years or 10, right?
Yeah.
So,
and that's super key, Michael. So we always want to understand the client's timeline because that'll dictate the level of risk that they're willing to take and how quickly and aggressive they want to accumulate. What I did myself was I actually started off with a 6% deposit with ANZ. So for a 500K property, you're probably looking at about 60, 65 grand to get into your first asset. That's including stamps and all other costs.
So you don't need a lot of money to start.
No, you don't. That gets you into the first one. In that time, you're building up the investing muscles. You're learning the process of buying property. So now it's a little bit easier when you go for number 2 and you've still got a hefty chunk of cash left over. Plus you've got the equity growth of property number 1 also working in your favor. So now you can go with maybe, depending on how much total borrowing you have, you might have the ability to also go for a second property with a different major using a 12% deposit. So again, now for a 500K property, 12% plus stamps, we're probably looking at about maybe 80, 90 grand, depending on the state that we buy in.
Yep. So with $200,000, you're already at 2 properties.
That's right.
And if you buy them with a good buyer's agent, right, you could buy them in a good data set area. If you get a sneaky little under market value to the, flooring and paint, a little bit of a value add, you could see 100K on each of those relatively quickly in capital growth. Exactly. And within 12 months, 18 months, you'll have another 200K to be able to buy again.
That's right.
So you can scale quite quickly.
Exactly.
Especially knowing what to utilize. I think you've opened my mind up there because I don't remember it was 20 years ago when I bought my first one. But using only the 6% and then the 12% and doing it strategically and going to the right lenders in that right sequence definitely fast tracks it, doesn't it?
Yeah, and the way to look at it is, so those major banks and tier 1s, and this is actually the topics that have been talked about by APRA recently, they have those buffers in place. So if the rates are 6%, the banks will add a 3% buffer to assess your repayments, being 9%. So you only have the most amount of difficulty borrowing with those major banks to begin with. So it makes sense to borrow with them first, and then you move to the more flexible lenders where they won't have a buffer because they're not regulated by APRA, but they'll have their own internal loadings. Maybe they'll only add a 1% interest rate loading or 2%, which opens up that servicing runway for you to now get a bit more money to borrow.
Yeah.
So
for everyone at home, so let's just say you're with CBA and CBA will assess whether you have they'll look at what you're earning and they'll see if you have the capacity to repay it. But even if interest rates right now are 6%, what's an interest rate now? 6%?
5.8, 6.
5.8. They will still assess it with an extra 3% on top, just in case rates go up.
Exactly. And we actually saw, this is where it's always a dichotomy because people always complain they can't get enough borrowing from the banks. But we saw in 2021.
There's never enough borrowing.
There's never enough borrowing, but we saw in, I think it was early 2022 from memory, rates being at the lowest they were. And then we literally had, like you said, those 12, 13 rate hikes consecutively. Which then showed to people the importance of banks having those buffers in place, because a 3% buffer, if you assume a 25 basis point hike every single time, that's 12 rate hikes accounted for with the 3% buffer.
Yeah.
So from the
and
banks,
that's roughly what we got, wasn't it?
Exactly.
Yeah.
So from the bank's perspective, by having those buffers in place, if the servicing passed in early 2022, it's already accounted for upside risk adjustments with interest rate rises. So cash flow shouldn't be an issue for those same people, assuming all other variables stay the same. So now investors appreciate that a little bit more, I think.
Definitely. Let's talk about now the DTI.
Yeah.
For those who don't know, explain DTI to everyone at home.
Yep. So DTI pretty much just means debt to income. So if the DTI is, let's say, 6, which is what APRA has come in to say in February 2026, they're going to put a 6 DTI cap. 20% of new borrowers. Yeah. That basically means if Yousof is earning 100 grand, he can't borrow more than 600 grand, which is a 6 multiplier.
Yeah.
Of 100
so that's
grand.
the 6.
That's the 6.
Debt to income. Yeah. And that was previously, what was it at? 8.
Interesting. So most of the major banks actually had it around 6 and sometimes, or some like ANZ would actually have the appetite to go up to 8 DTI. Now, this whole announcement, I think, has been over-exaggerated with people thinking that it's the be-all, end-all when it's actually not.
Because it's been all over socials lately.
All over socials and obviously fear-mongering, and that surges, speculation and, the amount of people that know what DTI is now and not 3 months ago. These are always interesting conversations being had as a broker. I always like comparing different timelines just because it helps for people to put things into perspective. So again, 2021, 2022, rates are at 2%. DTIs at that point were climbing up to about 8 for a lot of different clients with major banks. I think having a DTI cap of 6 would be more beneficial or restrictive if it was at that point of the market, as opposed to right now where rates are still around 6%, and most people are being capped at a DTI of about 4.5 to 5 with major banks.
Yeah.
What I think will happen is in a few years' time, depending on what the economy signals to us, if rates were to strip back to about 3.5%, I think that's when you'll see the DTI cap of 6 having its effect, actually show something.
Yeah.
But at that point, it's not going to be controversial anymore because the announcement was actually made in December 2025, and it's not going to be a thing in the media as much.
Yeah. 100%. So going back to trusts and investors out there right now, it's very important that they pivot and understand the correct strategy moving into 2026 for them, because the game's changing. It's evolving constantly, right? Give some of the investors a little bit of insight as to how they should be adapting moving into 2026.
Yeah, I think it ties back to what we just talked about, having your long-term strategy literally just plastered on your forehead or whatever you need to do, to understand that now we might need to explore some of those alternative lenders as opposed to the ones you're just used to, because that's all you've ever known. So we're going to see probably a rise in market share for lenders like the ones we talked about, First Mac, Brighton, MA Money. But I think a big part of it, Michael, is also going to be around mindset. I think one thing we've seen in the last 4 to 6 weeks is how quickly things can change. I think change always takes a long time, but there's been a lot of announcements recently, and it's all been really targeted towards investors. And it has actually dampened a bit of sentiment, I've noticed. But I think, and I was having a conversation with a client who was 23, and he already had 2 properties, credit to him. But I think as a property investor, there's going to be certain seasons where you're accumulating very aggressively, which is fun and it's exciting.
Yeah.
But there also needs to be an emphasis on the other levers in which we can control. And for me, the one thing that's universally able to be controlled that always has a positive effect on your borrowing capacity and all areas of your life is your income.
Yeah.
Now, I'm very mindful and empathetic that not everyone can always be in a position to do that. Some people's lifestyle is very rigid and their circumstances might not give them the ability to do that. But I think for a lot of people who are younger, they can pause for a bit, cool the jets, maybe take a year to really transfer the amount of discipline they're putting on their property investing into potentially increasing their income, whether that's a side hustle, whether that's attaining bonuses or commissions in the work they do, or if that's not possible, finding another avenue which is going to give them a bit of income growth.
Well, you hear constantly about a lot of successful property investors and how they work 1, 2, 3 jobs.
Yeah.
Right?
Yeah.
Just to get their income up whilst they scale. And once you've scaled it, it's easy. Everyone always talks about the first property being the hardest to get that deposit for the first one. And then people see investors go 2, 3, 4.
Yeah. Yeah.
That's because it's easier when you're in. The old money makes money story is very accurate right now.
Absolutely. And I think it's also, there's a sense of control that comes with it, right? I think one thing we've learned is to not surrender your control to one set of lender policy or one process, because if Macquarie and CBA have followed in stripping away trust lending or reducing their appetite, if other lenders do the same, then we're going to be very limited with what we can do in that particular department. But if we do look at the other levers like income growth, we might not even need trust lending as much as we thought we did.
Yeah.
So we're taking the control back to ourselves. And I think conventionally income has always been seen as a disabler, whereas I think we need to shift our mindset to thinking of it more as an enabler. And then we get creative with what we can do and what we can't do.
Yeah. No, well put. Going back to sequencing, I love this because I love strategy.
Yeah.
Right?
Yeah.
And I'm doing it on the asset side all the time. So on your end, I'm not a mortgage broker, and I love talking to mortgage brokers and hearing how they're doing all these different things.
Yep.
What are some of your favorite lenders right now that you believe are most beneficial to investors that investors should really start paying attention to?
Yeah, for sure. So I think
not that we're plugging banks, right? That's not the point.
Yeah. And things always change so quickly, right?
Yeah.
So bank selection and priorities will always change. And again, this highlights the importance of not speaking to your broker once a year, but if you're an investor, you should be speaking to your broker once a month, I think, to understand changes, if your strategy gets affected, how you can stay on top so you have more clarity in your decision making. So I think at the moment, one sequencing order that I really love is maybe going for the first one with a NAB. They've got 90% lend fixed interest only for 5.64%, which is really sharp.
Yeah, it's good.
And then maybe, if we're sitting on that for about a year, we keep CBA up our sleeve because CBA primarily will give us a higher valuation number than most other lenders do.
What are we calling it? The auto val?
The auto val, yep. So we can be cheeky and do that at the time of purchase as well to see how much upside we have on the equity coming into the deal. So if we have CBA up our sleeve, we've always got the ability to then refinance across, pull out the equity, and then repurpose our borrowing for the next lender.
Yeah.
And depending on how much the income is of the client and how much borrowing they have left, that'll then dictate, do we stay with a major bank? Maybe it could be ANZ this time. Or do we need to go down that spectrum like we talked about and exploring some of those more flexible lenders?
Yeah.
I don't like to use the word aggressive, but flexible lenders.
Flexible. Yes.
Yeah.
Fantastic. So for those investors out there a little bit worried about going to one of these lenders that, charges a higher interest rate and so on, second, third tier and so on, what comfort do you normally give some of these people out there that might be concerned about the fact that, hey, this, I've seen 5.6%, like you said, with NAB.
Yep.
And then over here, I'm getting 8.2.
Yep.
Right. So what, explain to me what a normal conversation with this client would be.
Definitely. So the first thing I'll always highlight to people is, hey, your strategy is to build a portfolio. Interest rate shouldn't be the most important thing when you're in your accumulation phase. And I'll always have to remind clients of that because human psychology, we always want to nitpick at the negatives. It is what it is. But once I say to them, look, this is the only solution for us to get into the next asset. If someone said to you, you can have this property, which is going to be worth X in number of years, would you take it? Yes. Are you okay to pay an extra couple of grand a year for it? The answer is going to be yes, once you reframe their mentality towards the solution. There are ways to make life a bit easier. And one thing we always do with our clients is if we end up going with, let's say, Liberty as an example, where rates might be north of 7% right now, we can put a bit of modeling into practice and say, look, Michael, if you hold this Liberty facility for 12 months and you've made your repayments, you've been good, your credit score hits a particular minimum, we can look at refinancing you back to one of the majors or maybe another lender we have on our panel without the same serviceability metrics we would need if initially needed.
Nice. It works out in the end.
So
it's just a matter of your mindset.
You can literally get an asset that these major lenders would not have given you the money for initially by just taking a two-pronged approach, borrowing from a lender that will give it to you, but then ironically refinancing back to that same lender using another policy niche of theirs for refinancing.
Wow. Yeah. And it's all about the cost of doing business. This is all it ever comes down to.
100%.
Pay the interest rate. If you bought the right property in the right area, right, data set, and you're making money, then that small cost of doing business is exactly what it is. It's the cost of doing business.
Absolutely. And so many early investors, right, when they've got one property, one loan, and we present them with some refinance options, if one lender is giving them 200 grand worth of equity they can access, but the rate is going to be 0.15% higher, they're always going to go for that option because that's what's going to move the needle faster towards their goals. At the back end, that's when we really start focusing on consolidating and sharpening up rates. If we can do it at the same time, fantastic. But I think the principle is to focus on what's going to give you the asset.
Yeah. And we want the capital growth from
100%.
that asset. And yeah, exactly. Portability, we touched on that on our conversation outside. Explain to everyone at home right now, what is portability and how it can work for them?
Yeah, so portability, and some banks will call it security substitution, is basically, I think it's better if I give an example to explain how it works. So for example, we had a client in 2021 who bought in Perth, 500K house. The loan was 400 grand, interest only. By 2024, that asset appreciated to 800K. The loan is still 400. Now, the client who's an investor thought to themselves, well, maybe Perth is at the back end of their performance in the cycle, but maybe there might be another location where the cycle's primed for better upside growth. So I'm going to sell this asset in Perth, keep the loan open, which is where the security substitution now takes place, keep that loan open, and depending on the bank and the policy around it, I can keep that loan open for up to 6 months and pretty much transfer it across a new property that I'm looking to buy. Why would someone do this? Well, there's usually two reasons. One, You don't have to really go through the whole process of showing serviceability again because the loan facility is already open. And it allows you to use that loan, the existing loan, plus the profits to repurpose towards another asset now.
In perhaps a good data set area that's about to go up again.
Exactly.
So you're maximising.
You're maximising it, and you probably don't have the serviceability to now borrow for that amount if it was day one, but you have the existing loan and the profits that you got from selling that asset.
Now, where I see this instantly, and for those watching at home, I see this for the investors that are maxing or have a considerable amount of properties in their portfolio, and odds are you can't go back to service again because your servicing is shot.
Yep.
This is the ideal thing for them. Now, for a lot of them at home now listening, the ones that are thinking, geez, what would that apply to me right now? Because I'm with X lender. How does that work? Is that with some lenders? Do you have to make sure you take out a specific loan that's portable, or do the majority of lenders have this? So
Yeah, majority of lenders do have it. It's just not a conversation that's proactively had with a lot of clients and brokers, I feel. And to be honest, not people know about it. It's not really talked about too much. But I think even from like a lifestyle perspective, Michael, if someone is taking paternity leave or mat leave and the income's going to drop by a certain percentage, it might restrict their investing plans. But when you've got this particular process from a bank that allows you to do this without the need to demonstrate income serviceability, you can still be agile with making moves, whilst your lifestyle shifts might otherwise say you can't.
I think the lesson here is have a good broker that knows all this.
Have a good broker, a broker that is an investor themselves and someone who has had their skin in the game.
Yeah. No, 100%. 100%. I want to thank you for coming on.
Thanks for having me.
Fantastic insights. And let's do it again.
Look forward to it, mate.
Thank you so much. Everyone, that's Yousuf Ahmadzai from Flint Invest. Yeah, if you have any questions, reach out to him direct. If you got a lot out of this episode, please like, share, subscribe. And until next time, take care.